Hi, welcome back. In the last session, we introduced the idea that knowing what's happened in the past in terms of prices for an individual stock or markets can help you predict sometimes what will happen the next day, the next week, the next 6 months. In this session, I want to build on that theme and talk a little bit more about price patterns we've been able to see over time, especially as they relate to things we can observe, what month of the year it is, what day of the week it is, what time of the day it is. In particular, there are three effects that academics in particular have chronicled, but practitioners have also noticed. The first is called the January effect. That Januaries tend to be the best month of the year to invest in, and what happens in January is often a good predictor of what the year will deliver. The second is called the weekend effect, which is in pretty much every year in the last century. Mondays have been much worse days to invest in than any other days of the week. There's a Monday effect. And the question is why? Why are Mondays such terrible days to invest in markets? And the third is, and this is a weaker effect, there is some evidence that mid-trading day there is a swoon in prices and there seems to be some recovery. I'm not sure any of these temporal irregularities, as I'm going to call them, are a basis for making money. But they exist, and might as well look at why they exist, because there might be clues on price patterns from what you can find. First, let's start with the January effect. Going back to 1927, I looked at average returns by month, January through December, from 1927 through 2024. Take a look at the returns, and it's kind of a no contest, right? The best month of the year by far over the last century for US stocks has been January. Now, before you get too excited though, if you look at the difference in returns, it looks big on a chart, right? But it's 3% versus 1%, but that's still pretty significant on a monthly basis. Now, if you want to have a different way of examining this, and this is for a shorter time, but 1926 to 2018, if you look at just January returns broken down by market cap decile from smallest to largest, you can see the January effect is almost entirely a small cap effect. In fact, with large companies, there is no January effect. So not only is there a January effect, but it's an effect that seems to be isolated to the smallest companies in the market. And it's strong across countries. If you look across every country, there's a January effect in pretty much every country. So let's summarize. There's a January effect. It seems to be strongest for small companies, and it's across markets. It's not something that is specific to the US market. What are the possible explanations? People have tried several. None of them fully fit, but you can maybe all of them put together can explain it. One is there's some fund flows, people sending money in December into mutual funds and that money being invested in January. Maybe there's a fund flow effect where there's far more money flowing into stocks in January than any other month of the year. The second could be window dressing by institutions. They're trying to get rid of their losers at the end of December so they look good on December 31st and they buy them back in January. But if that's the case, the January effect should be strongest in money-losing stocks than in money-making stocks, and the evidence for that is weak. It could be tax selling. Investors sell stocks in December to manage their taxes, and they buy back in January. None of these fully fit, but they might all contribute to understanding the January effect. The troubling thing is the fact that it's strongest for small cap stocks suggests that whatever the effect is something to do with market size as well, that whatever the factor is that causes the January effect is greater for smaller companies than for larger companies. The January effect, it exists. And as an investor, what can I do about it? Stay fully invested in January to begin with, but by itself, knowing what's happened in January doesn't help you that much over the rest of the year. Because once January is behind you, the rest of the year look pretty much alike for every single year. Let's look at the weekend effect. This graph, I've looked at returns by day of the week, Monday through Friday. And again, the standout is Monday. Mondays historically have been the worst day of the week to invest in US stocks, and Fridays have been the best days. Let's dig a little deeper. That weekend effect is not just again in the US, it shows up in pretty much every market. There is a weekend effect, stronger in some markets than others. The Philippines, for instance, the weekend effect shows up as a smaller positive return on Monday than on other days of the week, but clearly Mondays lag every other day of the week. And if you look at the US across time, an interesting phenomenon has popped up. Well, in every single time period, Mondays have been the worst day of the week to invest in. 1981 through 1991 through. No, there have been sub-periods where that's not been true. 91 through 2000, for instance, Mondays were the best day of the week to invest in. I don't know what happened during that time period, but that was the dot-com boom. Again, 2021 through 24, again, a good period for U.S. stocks. Mondays have been a good day of the week to invest in. So the Monday effect, to the extent that it's been around, shows up in very long time periods, but there have been sub-periods where it hasn't held up. So let's look at possible explanations. Again, the Monday effect is really not a Monday effect, it's a weekend effect. And here's what I mean by a weekend effect. That negative return you see on Monday isn't because of stocks doing badly over the course of the trading day on Monday. It's because they opened lower on Monday. There's some who argue that it's because bad news comes out over the weekend. And there's some evidence that companies try to manage news to come out over the weekend. But if that's the case, you should be able to exploit it, right? Because if you know this happens systematically, you should be able to sell short on Friday and collect your money on Monday. And there's no evidence that makes money for anybody. The weekend effect has become weaker over time, and maybe there's some explanation there. Maybe the fact that we can now trade in most things 24 hours a day, 7 days a week is kind of taking away the weekend effect. But there is that weekend effect. It might not be, again, the basis for somebody trying to make money, but it might become the basis for you timing when you buy a stock. You might choose to buy it. If you have a stock that's undervalued that you've decided to buy and it's Thursday, you might not buy it that Thursday or Friday. You might wait till Monday morning and buy it, because then, to the extent that there's a Monday effect, you might get it at a lower price. So you might incorporate it into some other investment philosophy. But as a standalone philosophy, it's probably not going to make you money. Intraday, again, if you break down trading days, there is some evidence that returns are different for different parts of the day. Who knows why? And this is truly a phenomenon, but there's not much. It's purely for cocktail parties. You can talk about a midday swoon, but it's not something you can take advantage of as a trader to make money. So across months, across days, even within days, there's a price pattern. Now, if you look at the interaction between price patterns and trading volume, there seems to be an interaction. High volume stocks, there's a much bigger difference in price momentum effect between winners and losers than in low volume stocks. So momentum tends to get stronger when volume is high than when volume is low. Something to factor in. So what's the bottom line? There are time patterns in stock prices, right? Januaries, Mondays, intraday, the midday swoon. But making money on these time patterns, it's very difficult to do. I can't think of a single investor who became successful over time trying to take advantage of just time patterns. But you might be able to incorporate those time patterns, as I mentioned, into your investment philosophy. So you might want to buy your stocks towards the very end of December so you can take advantage of the January effect rather than at the end of January. So those are things you might build into a traditional investment philosophy as an add-on, as an augmentation, but not as a standalone. I hope you found the session useful, and I thank you very much for listening.